China takes the bulk of Iran's exports, around 1.5, 1.6 million barrels a day. That oil has been moving despite the fact that US sanctions haven't been dropped. That's largely a story that rolled out over the Biden administration, but Trump was very clear, we're going to make Iran broke again, and we're going to do it through sanctions. And what's been interesting over the last couple of months is that there have been new sanctions, including, for the first time, the US sanctioning a Chinese independent refiner, a so-called teapot, a fairly large escalation in the sanctions campaign, although small at the same time. They only listed one independent refiner. Other than that, the US sanctions rollout has been pretty small. It's been gradual. It's more of a sanctions squeeze than a sanctions shock.
So the sentiment seems to be around a very limited upside for oil prices. We asked about the drivers of oil prices. 40% said it's going to be the recovery in the economy and the China demand story over OPEC plus plans and geopolitical developments.
On the solar side, the price differential is really dramatic. And that's actually the reason why these Chinese solar companies are very interested in the US market. If you compare, for example, a module price in China to a module price in the US, it's such a dramatic difference that these Chinese solar companies are willing to accept the political risk premium of setting up factories in the US, right?
Global solar module price right now, the ones that the Chinese manufacturers are basically subject to, is about 9 cents a watt roughly here at the moment. Whereas First Solar, they're selling their panels for about 30 cents a watt, multi-year contracted backlog.
An interesting data point, which didn't get a whole lot of attention. A couple weeks ago, the EU very quietly, without fanfare, dropped its commitment to entirely icing out Russian pipeline gas by 2027. They just dropped it. It's not there in the official sort of planning strategy forward. They're not making a commitment to completely cutting off.
On the China side of things, in terms of how the Chinese are thinking about US LNG purchases, we already saw some restrictions in January, right, in terms of the retaliation to earlier US restrictions, but those weren't really meaningful. Those were just more symbolic than substantive.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got a very special, fun conversation. We're joined by two analysts from Eurasia Group. If you don't know Eurasia Group, I would sort of generally describe them as the place to go and get the pulse on what's happening with geopolitics. So we've got Gregory, Brew joining us, and Herbert, Crowther. So very delighted to have both of you on. I think you're both generally based in the New York City metro area. Also, for the conversation today, we've got Salih, a regular here on this conversation, joining from his usual perch over in Dubai. And, in the run-up to having this conversation, we were talking about how, the geopolitics really does seem to be of interest here at the moment, with Russia, Ukraine, perhaps a bit more volatility out of the U.S. in terms of how we're approaching international discussions. And so, Gregory, let's come to you first. For anyone who doesn't know your background, you are a deep thinker on Iran. You've got a couple books on the topic, and I think Iran has been sort of central to understanding how to think about some of the geopolitics around oil markets. So given we've got a new administration in place and the thinking there probably has changed significantly, do you want to give us your just 30,000-foot view on how you're thinking about Iran here at the moment?
Sure thing. Well, Iran's actually been pretty busy over the last couple of weeks. It's been drowned out to some extent by all the news around tariffs, what's coming out of the U.S. domestically. Even the U.S. story around the signal scandal regarding U.S. strikes against the Houthis has sort of overwhelmed or overshadowed somewhat what's been going on with Iran. But the situation there is actually quite interesting. To roll it back a little bit, when the Trump administration came into office, myself and I think most of the oil world anticipated much tougher U.S. sanctions on Iran. Trump and the rest of his administration was very clear that they were going to crack down harder on Iran's oil exports to China. China takes the bulk of Iran's exports, around 1.5, 1.6 million barrels a day. That oil has been moving despite the fact that US sanctions haven't been dropped. That's largely a story that rolled out over the Biden administration, but Trump was very clear, we're going to make Iran broke again, and we're going to do it through sanctions. And what's been interesting over the last couple months is that there have been new sanctions, including, for the first time, the U.S. Sanctioning a Chinese independent refiner, a so-called teapot, a fairly large escalation in the sanctions campaign, although small at the same time. They only listed one independent refiner. Other than that, the U.S. sanctions rollout has been pretty small. It's been gradual. It's more of a sanctions squeeze than a sanctions shock. And this has had two impacts. The first is that the actual flow of Iranian crude to China hasn't really slowed down. It may be in the process of slowing down. The sanctions make moving the oil a little harder, makes it more expensive for Iran to move it, makes it more expensive for other actors involved, intermediaries out of the UAE, Singapore, Hong Kong, and China, who have been making a lot of money the last couple of years managing this sanctions crude. The new sanctions makes it a little tougher. But right now, the flow of Iranian crude to China hasn't really slowed down. There hasn't been a material impact, so the market hasn't really reflected that. The second important factor is that this all forms a piece of the Trump administration's push to get a new nuclear deal with Iran. Trump has been very clear. He wants a deal with Iran. He wants Iran to scale back its nuclear program. Also, very likely pulling back from supporting regional groups like Hezbollah in Lebanon, the Houthis in Yemen, which the U.S. is currently bombing very actively. And then maybe also making some concessions on ballistic missiles and drones. Trump wants a deal. But he's also said publicly, if he doesn't get a deal, he's willing to use military action. So in the last couple of days, in the last week or so, there's been a pretty significant increase in the amount of U.S. military hardware moving into the Middle East. There's been escalating tensions. There's been a lot of rhetoric, both from Trump and from the Iranians. But at the same time, very quiet back channel moves to try to get diplomacy going. So it's an ongoing story. As I mentioned, it hasn't been a sanctions shock. It's been more of a sanctions squeeze. But if diplomacy fails and the U.S. tries to get even tougher on Iran, we could start to see an escalation in the sanctions pressure that really starts to take barrels off the market, the way that analysts such as myself have been anticipating for the last couple of months.
Just to tie it into oil market a little bit here, just looking Brent crude at the moment, it's about $74 a barrel and change, roughly flat year to date. So none of the geopolitical factors seem to be exciting the oil market too much. Do you have a sense of, is there much geopolitical risk premium present in the oil market at the moment? How do you think about what all this means for the price that folks are paying at the moment?
I think there's a little bit. I mean, the risk premium is a moving figure, moving target. Everybody's got a slightly different view of how much is actually baked in. I think, the best way to judge the premium is when we see moves towards either escalation or de-escalation. So for instance, if talks fail or if diplomacy with Iran hits a roadblock and the U.S. starts to really up the pressure, we start to see, really meaningful signs that there could be a military escalation between the United States, Israel, and Iran. That's going to put upward pressure on prices. That's going to increase the risk premium. On the other hand, if we were to see de-escalation, if suddenly the Iranians and let's say Trump's envoy, Steve Witkoff, have a meeting, even an indirect one in Oman, the UAE, somewhere else in the Gulf, I reckon prices fall and the risk premium gets cut a little bit simply based on the view that tensions are falling. Similarly, Russia-Ukraine. If there's advance on ceasefire talks, if there's increasing noise out of the U.S. side that maybe sanctions are going to get dropped if Russia plays ball, that would yield a reduction in the risk premium because it would suggest things like attacks on energy infrastructure are going to become less likely, an increase in Russian exports or Russian oil moving back into the mainstream market becomes a little bit more likely. But overall, the risk of disruption starts to fall. But as far as how much risk premium is baked in right now, I think something I've been saying for the last couple of years is the market's gotten pretty good at managing risk, right? There's been a lot of noise. There's been a lot of disruption, a lot of headlines out of the Middle East and Russia, Ukraine over the last couple of years. But in many cases, it hasn't resulted in a really significant physical disruption. Russian flows have continued. Flows out of the Gulf have continued. So I think the market has gotten fairly good at managing volatility, applying a premium, but not a significant one, so long as the physical flow remains largely undisrupted. That's why something like Iran sanctions really matters, right? You have to see it reflected in the physical flows to really move the price one way or the other.
Okay, fascinating. And Salih, we're going to bring you into the conversation in just a minute here, but first I want to shift gears and come over to Herbert and talk. I think your expertise is a little less oil focused and more on the relationship between the US and China. And I think, a couple questions come to mind. One is that we're anticipating later today that we're going to see a flurry of new announcements related to US tariffs. And I expect that China will be part of that discussion. And so I'm curious generally about the US tariff regime towards China, whether you see that as being ratcheted up. And I'm curious, particularly given for folks who listen to this call, they probably know, but in case they don't, China controls north of 80% of the clean energy supply chain, particularly for solar. They're also pretty dominant in batteries, not quite as dominant in wind, but pretty large there too. So, how are tariffs going to affect China's ability to participate in energy markets, but particularly on the clean energy piece of the narrative?
Yeah, thanks, Rob. And it's great to be here with you and the team today. Similar to what Greg said about Iran sort of falling below the headlines, despite a lot happening on that file over the last few weeks, I think something similar has happened on the US-China side. We've had so much attention on Mexico and Canada dynamics, US-EU relations, that the US-China story has a little bit flown under the radar over the last 4 to 6 weeks. Our expectations are still quite cautious and pessimistic for the trajectory of US-China engagement over the course of this year. I think we'll almost certainly have a major new China tariff later today, right, at 4 o'clock or 5 o'clock or whenever that ultimately comes out. An important nuance in terms of the China perspective and all of this is Chinese retaliation to tariffs and all sort of US actions always comes upon the moment of implementation, not announcement. So one of the important things today as we watch the announcements come out are what are the effective dates, particularly for China. Because if it's not necessarily effective today, then the Chinese response won't have to come quite as quickly. We think that it's very, very hard right now to sort of construct a theory of the case for what a US-China deal could look like this year. There's lots of speculation, particularly on the US side, of what could China offer in terms of purchase commitments, in terms of investment, et cetera, et cetera. I think the pathway to finding something dramatically different than what the offer was during the first Trump term is very difficult to identify. And as a result, later this year, I think that reality is probably going to set in on both sides, and we'll see more of a focus on the US-China front. On the second half of your question, Rob, in terms of China's ability to participate in the international sort of energy transition, I think it's very important to separate the US discussion from basically everybody else, right? The US is adopting a posture on Chinese green technology, which is much more muscular and exclusionary than basically any other market in the entire world. As a result, being based here in the US, it's somehow easy to not fully appreciate the speed with which some of these Chinese green technologies are spreading in other markets, including a lot of emerging markets. For example, the Chinese solar companies are super active in the Middle East these days, right, where Salih is in the UAE and Saudi. That's a story which is not losing any momentum right now. The Chinese EV producers are also very ambitious in Southeast Asia and Latin America. That's a decision which most of them took in late 2022 and early 2023. For them, the US election is a speed bump, and obviously it's not positive, but it doesn't change their long-term plans for market expansion. So they'll have to be very careful on how they approach the US discussion, but more broadly, this doesn't dislodge their plans to continue growing overseas.
Maybe a follow-up question, given what you just said, is that the US has really built out its solar manufacturing supply chain over the last couple of years because of the Inflation Reduction Act. And, the future of that act is likely to get debated by Congress in the coming weeks and months. And I'm curious, is there any way that US solar manufacturers can ever compete with that supply chain that's been built up in China in the solar space, and maybe also just on the auto space as well. You know, we don't have BYD cars really here in America. I think they're really gaining traction in a lot of other markets, but you know, can the U.S. auto industry also compete with that new, very EV-focused set of manufacturers that have been thriving out of China here recently?
Well, those are also two very deep and profound questions, Rob. On the solar side, the price differential is really dramatic. And that's actually the reason why these Chinese solar companies are very interested in the US market. If you compare, for example, a module price in China to a module price in the US, it's such a dramatic difference that these Chinese solar companies are willing to accept the political risk premium of setting up factories in the US, right? Otherwise, you would think it's so risky. There's so many political headwinds. Why would they want to pursue this? The reason is the price gap is just so large, it makes sense for them to take a swing at it. Interestingly, over the last few years, that sort of US-China solar relationship has shifted from being about Chinese exports to the US and really being about the operations of Chinese firms in other countries then supplying the US market, including, for example, at the cell or panel level to feed final assembly. So US tariffs on China, which we see today, won't really affect the current equilibrium on sort of US solar imports. More relevant is whatever we see on Southeast Asian countries. One thing I just want to flag on the IRA dynamics, which you had mentioned, Rob, I think more likely than not, the advanced manufacturing credits in the IRA will be able to survive the reconciliation negotiations. Of course, most of these projects benefit largely from those advanced manufacturing credits. Where we could see much larger shifts separate from the reconciliation process is on the foreign entity of concern rules within the IRA. And there are some Chinese projects in the US where the Chinese partner does have significant equity. And whether those projects see tightened rules is for many situations more impactful than just the advanced manufacturing credits. I'll stop there. We could also get more into EVs, but that's another 20 or 30-minute discussion probably.
Fantastic. For those, just a quick data flag. We've got a great time series on the terminal. Global solar module price right now, the ones that the Chinese manufacturers are basically subject to, is about 9 cents a watt roughly here at the moment. Whereas First Solar, they're selling their panels for about 30 cents a watt, multi-year contracted backlog. And so that dynamic of, you get 3x, something like 3x the pricing in the US versus that more global figure. So Salih, let's bring you into the conversation. You were recently in China on visiting with our clients there. I think you got to sort of see how the rapid rise of EVs may be affecting things there. And so I'm curious though, because since you've been back, we have conducted a survey with all of our customers, asking them for their opinions on things related to energy markets, including the rise of EVs, the fate of oil demand as a result of that, and lots of geopolitical questions. So I'm wondering if you can just quickly give everyone an overview of what the survey told us. And I think then it would be great to get Greg and Herbert's reaction to those survey results as well.
Sure. Thanks, Rob. And it's great to be back on the call alongside some great guests that we have this week. Very briefly on your question on China, similar to what Greg said earlier, one observation that I made was clients were really curious to hear our thoughts on Trump being back in the White House on what that means for the oil market. And on the EV side, I mean, we spoke about this on the call a couple of weeks ago, but I'll repeat it. Anecdotally, I mean, it was quite fascinating to see how many EVs there are, at least in the central area of Beijing, where we were. And, they're pretty easy to spot with the green license plates they have. And I mean, of course, we already see this in the data series that we have, but it was actually quite fascinating to see in real life as well. And as you said, we published the results of our latest oil market survey in the last week or so. A lot of our clients may have come across the results on the terminal already. It was a long survey. We generally try to keep these as short as possible, but there's a lot going on in the oil market and we wanted to ask a lot of questions, but I'll try to be very brief with kind of the walkthrough, because I think I already talked too much in the other calls and we do have some great guests this week. Well, but first of all, I do want to say thank you to everyone who took this survey. I know a lot of our clients on this call gave their input, so really, really appreciate it. And I did promise that I would walk through the results. And as you said, some of the results will be very relevant for today's discussion. So a couple of questions on oil prices this year and next year. The majority, 60%, said Brent oil price will be below $70 a barrel at the end of this year. And another majority, also close to 60%, said they will be below $70 a barrel at the end of next year. Only 3% said that oil prices will be above $90 a barrel. So the sentiment seems to be around a very limited upside for oil prices. We asked about the drivers of oil prices. 40% said it's going to be the recovery in the economy and the China demand story over OPEC plus plans and geopolitical developments. That seems to be the key driver for, according to the majority, not majority, but close to half of the respondents. We had a few questions on Trump. 73% said Trump will be bearish for oil prices in the next couple of years. I mean, we've discussed this many times. I think it's the combination of tariffs, higher supply. I mean, he'll be pushing OPEC plus to increase supply, also the domestic shale producers, and the general preference by Trump for cheaper gasoline back home. I mean, going back to the discussion that we had on geopolitical risk premium earlier, a combined 74% said the geopolitical risk premium is below $5 a barrel. 36% said it's actually below $2 a barrel. I think, I mean, as Greg said, this is really a moving target and it's quite difficult to gauge, but I totally agree with him that it's going to be very headline driven. The headlines may say that the peace talks are going well and then it can go down, or vice versa. Oil price volatility, 70% said there will be more volatility in the next 2 years. We asked about a maximum pressure scenario on Iran and Russia. And even in that relatively extreme case scenario, only 50% see prices between $80 and $90. And only 7% see them above $100 a barrel. So this is in line with generally our view. We see upside limited even in the maximum pressure scenario. I know I said I'm going to be brief, but I realized there is so much to go through. But these were pretty much the most relevant ones. I will very briefly talk about OPEC as well, because we asked about OPEC. 63% said OPEC plus will remain intact as it is. And 23% said OPEC plus will remain, but some members will leave. There was a little bit of uncertainty around strategy. 47% said the gradual return that starts in April will continue. 48% said that the group will maintain its current production level, so they would pause the monthly output hikes. And we asked about the potential price war by OPEC plus, and 73% said it is very unlikely that OPEC plus goes for a price war, which I think shows and highlights the general recognition that the price war would be very, very damaging for all members. So we had a few more questions, generally about like peak oil demand, ESG influence on oil company strategy and stuff, but I realize this is taking a lot of time. So those were, I think, the most interesting ones and probably the most relevant ones for today's discussion. But yeah, thanks, Rob.
Thank you, Salih. For anyone who wants to read the survey results, just type BI OPEC Go on your terminal. You can find it there, and let us know what you think. Gregory, I want to get your reaction. I know you spent a lot of time thinking about the politics of the Middle East region. You know, what do you make of Salih's comments about, you know, kind of how some of our customers are thinking about both geopolitical risk premium and kind of the future of OPEC this year? You know, what do you make? Is OPEC going to successfully manage oil prices to their liking this year? Or, yeah, how do you read the tea leaves on that front?
So on the risk premium, I would agree. I'd say less than $5 a barrel now. But I mean, we have quite a lot of recent data suggesting that the risk premium can change quite quickly, that it can go up quite quickly. Last year was an incredibly tumultuous year for markets as far as judging the risk premium. You had direct strikes by Iran on Israel. You had direct strikes from Israel on Iran. For a week or two in October, there was serious discussion of Israel bombing Iran's main crude export facility at Karg Island. I happened to have been on paternity leave at that time, so that made for some interesting reading for me. But I mean, this year could also be dramatic, and you could see escalation in the Middle East, or at least discussion of escalation, and that's going to be reflected in a change in the premium. So less than $5 now could be a different story in a month or two. On OPEC, on the price and OPEC, I mean, I would agree. I think Trump is bearish for oil prices, but I think the market outlook is bearish for the year, with greater upward pressure in the first half of the year than in the second, from sanctions both on Iran and Russia. By the end of the year, though, that's going to get outweighed by sluggish oil demand growth from China, sluggish oil demand growth in general, honestly. I mean, you don't see, outside of India and some additional barrels elsewhere in the global south, you don't see big drivers of increasing demand growth. And that's going to start showing in the latter half of the year. On OPEC, I mean, our call coming into 2025 was that OPEC was going to increase in April. So we were a little bit outside consensus. When OPEC announced that they were going to stick with that call, I think there was some surprise on the market. But our view has been that the group is going to stick to this decision. It's driven by internal dynamics as much as anything else. The view inside OPEC is that we want to produce more. We got to get more barrels on the market. We've got to shift from market management to a market share capture strategy. The trick will be in how to manage that slowly. There's no desire to flood the market now. Saudi will lead the charge in gradually increasing production. But in how it actually gets sorted out in the numbers, compliance cuts are going to matter a great deal. That's where the drama is going to be, I think. It's going to be trying to get Kazakhstan, Iraq, Russia to a slightly lesser extent, and the UAE, most significantly, to comply with past cuts. I agree with the survey that OPEC is going to remain as it is, but there's going to be drama. There's going to be back channels. There's going to be some fireworks behind the scenes, starting in April, starting this month, as they proceed with their production hikes. But they're going to stick with their plan, and they're going to say that they're sticking to their plan. It's important that the group maintains its credibility around this production hike strategy, even as they try to balance it against compliance cuts, even as they try to keep the price roughly where they want it to be. But if it dips below 70, they'll stick to their plan. I think there is an increasing appetite to accept lower prices for a year or two, so long as it allows them to recapture market share and drive out marginal producers elsewhere.
Thank you. And for anyone who's listening, if you have questions for any of the guests, pop them into the chat. We'll try to work them into the discussion. Gregory, quick follow-up. That wasn't part of our survey, but I think it's here in the news cycle at the moment. President Trump just put out an executive order maybe a week ago, could have been 2 weeks ago, talking about Venezuela. And it seems that some of the tariffs that may be coming later today might target countries that are continuing to import oil from Venezuela. So I'm curious, you know, what do you make of the dynamics there? Do you anticipate anything surprising to come out of the focus on Venezuela? Because I feel like Venezuela was sort of out of the news cycle for some time, and suddenly here it's back on the radar again.
Yeah, well, I mean, Venezuela, unlike Iran and Russia, is an important supplier to the United States. Has been forever, right? If I could put my historian hat on, Venezuela was a very important supplier for the U.S. when it was a net importer throughout much of the 20th century. And I think the position of the Trump administration is, look, we're going to pressure Venezuela on other aspects. There's obviously a lot of hostility between Caracas and DC, has been for years. But at the same time, there are U.S. majors, Chevron being the main one, that have historic interests and historic investments in Venezuela. And there's a market for Venezuelan crude inside the United States. What they're trying to do, I think, is put up barriers around Venezuela, squeezing Venezuela while also squeezing largely China, which is the other major taker of Venezuelan crude, but at the same time allowing the US to retain access to this crude, right? As Salih mentioned, Trump wants gas prices low, and keeping gas prices low means maintaining access to whatever sources of oil that they can get in order to keep the price low domestically. I also think maybe, and this is largely speculative on my part, given the fact that Venezuela produces a lot of heavy, and Canada produces a lot of heavy, and there's so much friction in the US-Canada relationship, there could be some thinking inside the administration that if they hold on to Venezuelan heavy crude, that might serve as an offset against any potential reduction in access to Canadian heavy crude, perhaps not now, but in the years to come. The problem there is the volume. Canada exports, I think, over 4 million barrels a day to the US. Venezuela, it's less than 500,000 right now. And no, I don't think any great scope to increase those exports anytime soon. Venezuela is a basket case. It needs a lot of investment. It needs a lot of money to increase production to where it was 10 years ago. So I think this is still largely a marginal story, but it might matter a great deal to this administration as it balances domestic interests, the desire to keep prices low, and these various foreign policy files.
Okay, thank you. One of the topics that we've spent a lot of time on this call is historically is the sort of rise of the U.S. as an LNG exporter. I believe the current figures have us in the #1 slot, though I know it's neck and neck with Qatar and there are other big players out there as well. And I'm curious if either of you are worried about retaliatory tariffs affecting our ability to play an outsized role in the traditional fuels. So we already talked about solar already a little earlier, Herbert, but I'm curious, what about the LNG story, the liquid fuels story? Are you worried about trade tensions that might get ratcheted up later today, even affecting some of the U.S. position on energy exports from America?
Yeah, I can start and then hand over to Greg. On the China side of things, in terms of how the Chinese are thinking about US LNG purchases, we already saw some restrictions in January, right, in terms of the retaliation to earlier US restrictions, but those weren't really meaningful. Those were just more symbolic than substantive. The sense which I have from Chinese purchasers is still that they're happy to expand US commitments, but the structural environment that they're in is very different than the first term, right? Over the last 5 years, the Chinese bureaucracy has become much more confident both in domestic renewables and more reliant on domestic coal. All of that just leaves LNG from strategically unaligned countries in a much more speculative and less positive position. So I think we could still get more purchases from some of the big Chinese off-takers, but they'll be flexible and they won't be the core of their long-term plans, right? So that means in the US-China trade context, LNG is not going to be the pillar of a new trade deal. We've also heard some rumblings from the new German government that the reliability of US LNG may be a little bit more suspect than previously thought a few months ago. But there's lots of other purchasers. I don't know, Greg, if there's any which you highlight as well.
Sure thing. I can come in here. So yeah, I mean, the US exports a lot to a lot of different places, but the markets that really matter are China, as Herbert mentioned, which is a market the US might start to get squeezed out of. Owing in part to what Herbert emphasized, structural changes inside China that may de-emphasize emphasis on LNG. But the other markets that matter, I would argue even more, are Northeast Asia, South Korea, Japan being the biggest ones, and then of course Europe. I mean, these are markets that take a lot of US LNG, where there are growth prospects to increase overall exports. That's what's driving, I would say, bullishness in the US domestic gas sector. It's not power demand growth linked to AI or other things. It's export demand growth linked to increasing demand for LNG. That's what's pushing forward new export terminals. That's why domestic gas producers are so confident that they're going to have a strong market moving forward, given the disparity, given the arbitrage opportunity between Henry Hub and TTF and the Northeast Asian price indices. The issue here is, if you start to see significant pushback, there's already doubt, as Herbert mentioned, in Europe about the wisdom of relying on US LNG. But if you really start to see pushback in the form of retaliatory tariffs or retaliatory action, that's when the White House starts to get phone calls. They get phone calls from the Hill and they get phone calls from Houston. And the phone calls will be, hey guys, maybe don't take these tariff actions that are pushing us out of our markets and impacting US energy dominance, right? If we want to continue to dominate the energy space, we need access to export markets, and that might start to influence tariff policy. And I think you've seen a certain amount of reactiveness from the administration when it comes to pressure points like that, that may impact how these tariffs get rolled out. But I think it's a considerable risk, because other actors, other trading partners, Europe, Asia, what have you, have signaled that they will respond to US tariffs if they impact economic sectors of importance, and that will include energy exports if the tariff actions continue to escalate.
You know, we're going to have a debate another day on AI, energy demand, and its role on gas. Really cool story from our colleagues over at Bloomberg News this morning about a conversion of a former coal plant in Pennsylvania to host data centers. And I think the takeaway is that there's potentially 4.5 gigawatts of gas capacity that's associated with this new project. Very big numbers that we're continuing to monitor there. Maybe just one quick follow-up though for you on the sort of gas narrative as it pertains to Russia. I've always just found it fascinating that Europe has effectively cut off the pipeline gas supply from Russia into Europe. I mean, it's not zero, but they've greatly curtailed it. But they don't seem to have had too much concern about taking Russia LNG volumes, which is a bit strange to me. So do you have any like read on that dynamic, and kind of how do you see the Russia piece of the story playing out this year? Because, you know, if we do get a resolution to the conflict in Russia, Ukraine, our analysts think that's quite bearish for gas prices in Europe. But I'm curious if you have any read on that conflict and any read into European gas prices as a result of it.
Sure, I can take a first stab, and then Herbert, if you want to weigh in, please do. So an interesting data point, which didn't get a whole lot of attention, a couple weeks ago, the EU very quietly, without fanfare, dropped its commitment to entirely icing out Russian pipeline gas by 2027. They just dropped it. It's not there in the official sort of planning strategy forward. They're not making a commitment to completely cutting off. And the reason for that is Slovakia, Czechia, you know, those Eastern European states that continue to import Russian gas, Hungary being another one, they want to continue to have access to at least a little bit of Russian piped gas to take the pressure off overall prices. So that's, you know, there's been an interesting internal shift. LNG continues to come in again because they want flexibility in order to meet gas demand and try to keep prices low given the amount of price volatility that they've seen. Overall, Russia's days as being Europe's main supply of gas, piped or otherwise, those days are over. Germany, the main importing markets, they're not going to take Russian gas in huge quantities anymore. The security risk is simply too great. The geopolitics on this have shifted too hard to adjust that relationship. They're going to continue to take Russian energy, again, in order to keep the prices low. But this geographic alignment between one of the largest natural gas basins in the world and one of the largest energy importing economic sectors in the world, that relationship is done. And it's probably never going to be reforged. Where Europe turns to for its gas and for its energy needs otherwise is a huge question that the EU is still trying to grapple with. It's why this US relationship is so complicated. But there are other sources of gas. There's Norway, there's North Africa, there's potentially Eastern Med, although I don't see that moving one way or the other. But overall, the commitment will be to clean up Europe's energy sector, shift more firmly towards both renewables and also just consuming less gas in general. That's the direction of travel. But as far as turning the taps back on Russia, keeping a little bit flowing helps to keep the price pressure down. But nobody who really matters in a position to really make this decision wants to see that relationship reforged. But Herbert, feel free to throw anything else in that I may have missed.
Well, just, Rob, what you had mentioned on the difference in terms of piped Russian gas versus Russian LNG is also very interesting in the Chinese context, where Chinese LNG purchases from Russia continue to go up. But the dynamics for new pipeline projects between China and Russia are much less optimistic. Greg and I have had many conversations about Power of Siberia 2 over the last 18 months. And the reality is that those discussions are not progressing very much because the Chinese just don't want to lock in a purchase commitment on this level, right? It would be such a long-term commitment. And from an energy system planning point of view, they are increasingly confident that they can cope without that, right? Through domestic renewables, domestic coal, and flexible LNG. So this is really a big shift in mentality and shows that I think for all of the potential off-takers, those rigid long-term pipeline commitments are becoming a little bit less attractive in this moment than the flexibility of some of those LNG pathways.
Thanks, Herbert. Salih, let's bring you in real quick. You've done work over the years on East Med gas. I wonder if you want to share some thoughts there quickly.
Yeah, I mean, we haven't written on it in a while. I know there's been some movement, but as Greg mentioned, I mean, not enough to kind of be the savior for Europe. But, there was potential, especially after Egypt's Zohr field, which was transformational and I think kind of de-risked, especially that region. So there's a lot of potential, but the export options and export optionality was a big issue. Especially for a lot of the gas around Cyprus, I think, where what would make the most sense would be to pipe it, to get it to Turkey and then to pipe it from Turkey. But then there were a lot of political and geopolitical challenges there too. So it's not something that I followed very closely as we used to, and we haven't really written anything on it in the recent past. But it's one to watch, but I haven't really heard of any significant movement recently.
Okay, thanks, Salih. And from the chat, recommendation to have on Tim Latimer, CEO of an enhanced geothermal company. I don't know him, but if anyone knows him, give me an introduction. We'd love to talk about geothermal. Very, very fascinating corner of the market here these days. Okay, so we've run over quite a bit, but I want to maybe just, given we have the brain trust on from Eurasia Group, I want to ask both of you to give us some sense of, we've had a nice discussion here today, but maybe if you can conclude for us by telling us, what haven't we discussed that you think is interesting that could affect energy markets in 2Q or the rest of 2025 here. So Greg, we'll come to you first. What's on your radar that's important that folks aren't talking about enough?
Well, I think in the OPEC story, the OPEC narrative about them increasing, certain states, analysts tend to over-index a little bit. Saudi Arabia being one, Russia being one. But the story on the back and forth between increasing and cutting for compliance seems to largely have been driven by Kazakhstan, which is not a member of OPEC. It's a member of OPEC Plus. And Kazakhstan is in a very, very interesting position. It's invested heavily, it and the super majors that are involved, Exxon and Chevron, have invested heavily in increasing capacity over the last 2 years. They're in a position where they want to increase production. They've only been a part of OPEC Plus with Russia since I think 2017. So they're not a committed member of OPEC. They're reliant on Russia and other transit states to get their crude to market. So they're not in a totally, they're not in the strongest position that they could be. But at the same time, the position in Astana is we're going to increase and we might not care too much about what the rest of the group thinks. That could be a huge friction point within the group. And the numbers we're looking at are not insignificant. It's 300,000 to 400,000 barrels a day, perhaps even more. and in a fairly tight market with bearish sentiment, I would say overwhelming bullish, that could have a pretty significant impact on moving the price on margin. So I would say, focus on Kazakhstan, Iraq being another story. Iraq is in a similar position in that they want to keep producing. They want to put more crude on the market. They're under immense pressure, the government in Baghdad, both from the other members of OPEC, but also from the United States regarding the Iran file, regarding putting pressure on Iranian groups there. And they need to keep exporting to meet their budget needs, to meet their fiscal needs. Iraq is teetering and has been for a while. So I would say the big story for OPEC is what happens in Kazakhstan, what happens in Iraq. And then finally, the old boring point, but tensions between the US and Iran have kind of never been this high. And the risk of an escalation this year is considerable. That's been pushed out of the headlines a little bit, but I would encourage people to keep an eye on that. Things could move quickly, either in a good direction or in a bad direction over the next few months.
Herbert, over to you.
I'll do one domestic one, Rob, which is not a new topic, but I think the tone shifting on a very popular topic, which is this, data center AI electricity demand question. From our perspective, and we just put a piece out on this yesterday, this conversation could be very different 4 months from now, right? We expect the reconciliation package to pass before July 4th, depending both on what the permitting language in that looks like, plus what happens to the investment tax credit and the production tax credit, ITC, PTC. I think by the time August gets here, we have a very different environment for the trajectory of the US power sector going forward. And I think as we've seen a few of the sort of data center demand projections moderate over the last few weeks, I think we'll have a much clearer picture of where US power prices, US power sector decarbonization is heading by August. I think it'll be dramatically different from where we are right now. So I think that's also just perhaps an early flag for folks on this call for how much things will change.
Fascinating. Salih, we're going to come over to you for last word, 2Q and beyond, what are you paying attention to that you think could be a big catalyst for the markets?
I mean, that's, I think, been pretty perfectly summarized, but on the oil market, and I know we had a couple of questions on the Q&A section on what happens to oil. I mean, I generally agree with the sentiment that we saw on the survey results. Generally bearish tilt to prices from here onwards, I think. Perhaps not in the second quarter per se, but as Greg mentioned earlier on the call, I think when we look at the second half of the year, a pretty soft demand picture. But between now and then, I think a little bit more of what we've had in the last few weeks, perhaps, just a lot of uncertainty and a lot of conflicting drivers. I mean, sanctions on Russia and Iran, the OPEC production hike that started this month, what happens with that? And again, I do agree that I don't see a pause. I think they will keep with the incremental monthly increases. And the US crude data that we look at weekly, and that can be very conflicting from week to week, but we continue to watch that very closely as well. And of course, tariffs, generally we've been arguing that this can be quite bearish. It's bad for global trade and hence bad for global demand and hence bad for prices. So I think towards the end of the year, it's going to become a little bit more apparent, and there's going to be a lot of pressure on prices. But between now and then, a lot of volatility.
Okay, thank you so much. Everyone, I want to thank you for joining today. We hold these calls every Wednesday at 10 a.m. New York time. To contact both Gregory and Herbert, you can look them up on bio on the terminal. They're both active on X, Twitter as well. Actually, everyone on this call here, I think all four of us are still out there using that platform. So give us a shout on Twitter, look us up on the terminal. There are many ways you can reach us, and I hope we see everyone next week. Thank you so much for your time, Gregory and Herbert, and look forward to having you on again someday to talk about some of these topics more. Take care, everyone. Cheers.
Thanks, Rob.
Thanks a lot. Thanks, Rob.